Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us now, what a privilege, in studio here, Seema Shah, who really has had an impact on the view of global economics, I should say, from London, from the United Kingdom. She's probably here in pre-prep for the president's trip.
Doing some,
some protocol and that kind of thing. I can understand it. Welcome. Thank you so much for joining today. I see your lengthy note here, but what we really want to know is, how does this equity market keep on going? Do you buy the gloom, sell the news Wednesday at 2 p.m.?
Thanks for having me. It's great to be here. Well, we're still positive on the equity market. I mean, I think it's more of a muddling through. It's difficult to see any major catalyst which is going to create this very big upward leg from here. But as long as the economy is chugging along, and yes, it's slowing, but we're not expecting recession, the earnings picture is still pretty positive, it can keep going up. I just don't expect to see very significant returns.
Frame the animal spirit of nominal GDP. The ECB has to confront certainly a sub 4% nominal GDP. What's that statistic versus America? There's a huge difference in the growthiness of America versus Europe, isn't there?
Yeah, there is. There is a really significant difference. And I think what's been interesting is that for this year, you've seen that investors almost turned away from that very significant difference and putting a lot more focus on Europe. That seems like it's faded a bit in the last few months. And certainly from our analysts, they're looking and saying, look, the fundamental picture for Europe is not as good as the US. Yes, there's a slowdown in the US. There's likely to be a slowdown in Europe at the same time. It's difficult to avoid that. So how can you continue to be very positive on Europe versus US?
Will you tell Chairman Powell the operative word at the press conference on Wednesday, solid? He loves saying that. It's a solid economy. The Red Sox looked solid last night.
Did they win? I went to bed before the end of the game.
They won. Right. Seema told me that,
I do have a tendency to use the word solid as well. Yeah, I think that's a good description for the US at the moment. We're expecting, as I said, slowdown, the trough in the growth picture around Q4, Q1. And then a gentle rebound through 2026, but not really going above trend growth in the US. So it's a meh picture. It's nothing particularly exciting, but you don't necessarily need to have exciting to see equity markets continue to rally.
We wait with bated breath for that statement and whatever adjectival descriptor that the chair uses to describe the economy. There is this debate, as I mentioned, between 25 or 50 at this meeting. How do you see that shaking out? Can you understand the rationale for those who do think that the Fed might want to go bigger at this point in time?
I mean, I'm standing very heavily in the 25 basis point camp. I've been saying that a 50 would be really about politics more than economics. Having said that, I guess I do have to pay some kind of lip service to the fact that, look, once the unemployment rate starts to rise in a normal environment, take out the labor supply issues, then it does typically spiral. So you do want to get ahead of it. But at this phase, looking across a broad set of economic data, earnings, credit spreads, there is very little here at this point in time to justify that kind of emergency-sized cut. So I would have to say there's something political if you get a 50 basis point.
How did you then interpret what we've seen over the last week or so in terms of labor market data? So first that monthly jobs report, the revisions, weekly claims, which surprised the downside as well. Taking all of that in aggregate, what's your sense of where this labor market is and where it's going?
Yeah, I think that there is a slowdown in labor demand. I think we can clearly see that. But the labor supply issue is almost offsetting the magnitude of that weakness. So there is something underway. It does need to be the Fed does need to get in front of it. But are we moving to a point where we can start talking about recession realistically? I don't think we're there, but the Fed does need to come in now in order to stop it from deteriorating to that point where you do become recession does become the key word again.
How does a dollar fold into this? I mean, I know I did one chart today, folks, and the in-betweenness of the dollar right now is remarkable. I guess it's resilient. That's the way the street's looking at it. But are you looking for a catalyst for dollar movement, or do we just get used to sleepy dollar?
I think that the dollar can move a little bit lower over the coming months, simply just from a central bank perspective globally. The US is the one which is still cutting rates. You're seeing a lot of the other central banks at least coming to a pause, or if not a complete halt. So from a fundamental perspective, that should put a little bit further downward pressure on the dollar. I think the key question is as we know about the smile for the dollar, when you do see that global weakness or US weakness, typically the dollar tends to strengthen. That's what we've seen in the last week or two. I don't necessarily think that's going to hold, especially if you continue to see this pressure on Lisa Cook, on Fed independence. Those are all things which are slowly eating away at the strength.
Talk a bit about that, because we're at this kind of pivotal moment where we don't really know which personnel are going to be around the table when this decision is made this week. Lisa Cook fighting to be there as kind of a normal governor, fighting that out in the courts. The governor, of course, pushing against her. The administration is. Stephen Miller has a vote tonight in the Senate. Will he make it in time? We'll see. Seems likely. How much does personnel matter as the Fed gets together to make this policy decision?
I don't think it necessarily matters for the rate decision on Wednesday. I think it's when you get further out into questions really about the independence, how quickly can a Fed governor be fired at will? But also at some point in time, the numbers game starts to really play through. And I think that for 2025, I think the forecast is fairly clear. It's, 2 or 3 cuts. It's when you get into 2026 that you can't forget about the politics. And I think that's where the muddiness of the forecasts are really sitting.
Seema Shah with us to get us started today. A good conversation here with the principal group. Futures up 13, Dow futures up 75. Good morning across Waking America. Good morning to the nation. Henrietta Treyz will be with us here in a bit on Washington. On YouTube, subscribe to Bloomberg Podcasts out on YouTube. It has been an extraordinary 3 or 4 days here. Thank you for your support. David, how about this? Seema Shah. June of gloom, June of 2020, in the FT. I got to read it in entirety, folks, because it's shocking. When apparently positive signals can turn negative, June of 2020, big negative. And back again in a short time frame, it makes sense to weight portfolios with high-quality defensive assets such as mega-cap tech stocks and investment-grade credit with a bias towards the United States. Anything much riskier than that looks set for a white-knuckle ride. You crushingly nailed it there. I mean, do you just reprint that paragraph again here?
I should have it plastered on my forehead. That would do me well. But I think, in 2020, not many people got it wrong, right? Either you, if you got out of the market,
stop.
of course.
I interviewed them all.
Says something about the booking maybe on the show.
I think there's a really big learning there from 2020, which is that, look, it looked horrific. The global economy went through so much. And yet in terms of the US dynamics, the US market, it recovered really, really quickly. And to me, that's one of the key things here, is that it's very difficult for the US to have a prolonged recession. It's very difficult unless you have really major balance sheet issues.
Let me cut to the chase. In June of 2020, you said free cash flow is going to sustain in the United States of America, including mega cap. Can you say the same thing today?
Yeah, I think with slightly less enthusiasm, but certainly we are long-term holders of that mega cap tech trade. We believe that there will be volatility, there'll be question marks about earnings. There'll be moments where the market will be rattled, but we do genuinely believe that is the frontier of productivity for the world. And so you want to keep having exposure. I think maybe the thing that investors really need to start thinking about is where next? Where beyond the mega cap tech trade do you want to be looking? And then I think there are lots of opportunities across all sectors, and that's what's going to really set apart the winners from the losers.
I've seen a string of these stories casting doubt on the viability of the AI narrative. There was a study out of MIT. 95% of whatever isn't working out in the way that people thought it would. I saw this latest thing from Anthropic that we're not using it to sort of do anything more than boost our individual productivity. This may be a dumb question, but do you as an investor have to buy into that narrative fully? Or can you just look at the way that these mega caps are performing and take the ride? In other words, how much conviction do you have to have in the story itself?
I think you need to have some kind of conviction in what the future of the world is. But I think it's fair to have your moments where you become a little bit cynical. When you look at the valuation, yes, exactly. You look at those valuations, you say how much longer can they really continue to deliver these kind of revenue growth, earnings growth. So I think that's fair. But I do think that for some companies, for some strategies, that is very much a long-term theme. We're not talking about 1 or 2 years. Right. We're looking at it from a 5-10 year perspective. So you have to be able to be willing to live through some of those dips.
On a Monday, can we do an audible?
Sure.
It's still, we're not deep into Tuesday yet.
I won't be here. So
I see it like the chart this weekend that France has a worse fixed income positions than Spain. As just one example. From the city in London, are you watching the tumult of Europe and saying it's over there, it's distant, it's not going to upset the apple cart? Or is it inextricably part of what's going on?
I think that they are two separate situations, but the UK has its own very meaningful fiscal situation, which has nothing to do with France, cannot be rectified by maybe France resolving its own situation. I think this is a global theme, but they're all very kind of individual stories which are going on around the world. For the UK, obviously for France and the UK, these are quite urgent situations. I struggle to see how, for example, the UK can emerge from this completely unscathed.
Right.
The budget is going to be a very, very difficult moment for Rachel Reeves. And when I look across the UK to the gilt market, I do have genuine concerns about where we go from here for the UK.
Is that a traditional concern where it's just out longer duration, or can it really upset the entire curve?
I think it could upset the entire curve. I think there's enough concerns about the credibility of the government. What is the escape route for the UK? And I think it's very difficult to know what that is, because the typical drivers of that would be productivity growth, immigration. Those are two things that we seem to have closed the door on.
But am I correct, to those of us distracted by the Detroit Lions scoring 52 points this weekend, 100,000 plus people protested in London this weekend?
That is correct.
If we have a Trump, I'm being very simplistic, Seema. If we had a Trump moment and Reform won, how would that change finance and fixed income in the United Kingdom?
I think what we could see is, again, you have to take a longer term perspective from a political perspective for the UK. And you do get to a point where the productivity concerns really do start to explode once you have these kind of movements.
Right.
There's a very potential change for the government, change of government at the next election to that far right movement. Ton of implications for the long term growth of the UK.
Please go ahead. I wanted to talk about Tottenham.
No,
That's okay,
before we get
please.
there. Many of us here became familiar with Manu Shafiq when she was at Columbia University. Some of us know of her from her tenure at LSE before that. She's now back in government and has this role as economic advisor to the prime minister. What does that dynamic look like between her and Rachel Reeves going forward here? How is her expertise going to be used? Are we just setting the stage here for a conflict, or does she stand some key role here in trying to right the ship that you're describing?
I think she does have a key role here. But I think that the UK, it goes beyond just the kind of the simple economics. And I don't know if she can genuinely push this narrative of changing the entire makeup of the UK economy. Where is it heading? So I think there are really deeper, almost introspective questions that the UK needs to be asking that goes beyond economics. So I think it's great, and it's great to have credible. Absolutely, having credible policymakers like that really does help the UK at a time when there's so many question marks about who is in government and who is who's essentially ruling. Yeah. But I think they have their challenges really cut out.
Get your Tottenham question.
Seema, I guess it's too late. So we'll do it next time. We'll do it next time after they lost 4 in a row. Seema Shah.
I support Arsenal, so I'm happy about that.
Yeah, I know. She's, I tried. All the fine, it's like
you're all alone in your Tottenham fandom.
Way alone. I had no idea how alone I was. I was having a cigar at some fancy London hotel. Everyone in the room was an Arsenal fan.
Yeah.
Like 110%. It's ridiculous. Mrs. Keene had a Tottenham hat on. Okay. So we got the bad service. We got Seema Shah. Thank you. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Joining us now, Henrietta Treyz, Veda Partners on your Washington. Henrietta, I want to do an audible here. David's got a lot of smart things to talk about. But I noticed 10 U.S. senators, 27 House members already have announced their retirements into next year's election. Why are we seeing so many retire as the 2 this weekend?
Yeah, they're dropping like flies. I have the benefit of having this incredible mentor, a woman named Ashley Miller, back at the U.S. Chamber of Commerce. And she told me several years ago that senators and congressmen are heading for the exits. DC is incredibly unpleasant to be in. We are knocking at the door of eliminating the filibuster, which any Senate staffer will tell you is what keeps the Senate from being the House. And they mean that as an insult. So it's definitely not a good time to be down there right now. I think the assassination of Charlie Kirk is certainly on the forefront of people's minds. The physical violence component of it really can't be under stressed.
I saw Michael McCall also announcing his resignation, or not resignation, but not seeking re-election once again. So this is happening in the House as well, isn't it?
Yeah, it absolutely is happening in the House. We're up to 2 House Republicans from Texas, if I'm not mistaken. The one that was really surprising to me is some of the farm state members. I'm thinking of like Joni Ernst, for example. Those members should be in really safe re-elections, but the potential for having to vote on tariffs, the trade wars, the discontent with farmers are all issues that are plaguing them, aside from just the general lack of comedy in D.C. right now.
You two are grizzled pros at this. I'm the hack. David, they're just retiring because they're getting out front of the Democrats winning the House. Am I too simplistic?
That might be a little too simplistic, I think. But Henrietta, you bring up the kind of difficulty in farm country especially, and I think there's been a theme to the newspapers and news sites I've looked at over the course of the last week, and that is this level of dissatisfaction and worry among soybean farmers in particular about their prospects in light of these trade policies, not having a buyer in China. How does all of this sort itself out?
This needs to be sorted out at the top levels. Like, this needs to be a prominent topic of conversation between Besant and Jameson Greer in Spain today with their Chinese counterparts. We need to be talking about soy purchases. Unfortunately, when we start inserting NVIDIA and TikTok into the conversation, I don't think there's a place for any kind of give on soy purchases. And we're seeing, and the farmers' main concern is that they are permanently losing market share to Brazil and Argentina from the world's largest purchaser of soybeans at 61%. So the farming community is doing something that really you don't see from a lot of other businesses. I would talk about, car dealerships, for example. They're a huge political donor base, and they're being really quiet about the tariffs. They're only hiking new car prices by 1%, but used car prices, which is the bulk of their sales, are up 6% as they try to stay on Trump's good side. The farmers, though, are putting out public letters, and they have been for several weeks now, and giving a lot of news interviews on the record saying how problematic the president's trade war is for them. They do not have any sales to China going forward, and that's a death knell for them.
I look at this and wonder, is a bailout inevitable? So I gather that Trump won isn't prologue for all of this.
Farm Aid.
Farm Aid, yeah.
Willie Nelson could play.
As he is, I think tonight. But, Henrietta, I'm curious, is that where all of this is headed? Are we going to see a $20-30 billion bailout, the likes of which we saw the last time around?
Yeah, we got 3 of them last time around. I suspect we'll get another one this time around. There's already rumblings from members, specifically on the House side and the agriculture committees, calling for the insertion of a farm aid package in the upcoming CR that will avert a government shutdown. So it's definitely already part of it. There was some of that in the One Big Beautiful Bill. There was some rejiggering of some of the methodologies and accounting for how farmers get subsidized. And that's going to be expanded on in the next package, I would suggest.
Another dumb question, only Henrietta Treyz would know this. When there's a farm bailout, who gets a check? A mom and pop farmer with 200 pigs on a ranch in, Kansas? Or is it like corporate America gets the check?
It's both, and it's usually run through the Department of Agriculture, through a really small entity there that was heavily accessed during the president's first term as the U.S.-China trade war kicked off. They replenished this fund that goes specifically to commodity purchases, and that's how the money gets funneled. And I suspect that's what they'll do again. They're having pretty advanced talks about it now, but still relatively rudimentary. There's no text, but I would imagine that's what they do.
If we're growing tomatoes on the deck, do I count as a farmer?
Tom's beefsteaks on the deck. Yeah. There you go. Henrietta, we have this irregular series with you where we ask you what a recess is going to be like for lawmakers when they go home to their district. So let's pick that up again. Let's do another edition of it as we face a 10-day recess here starting at the end of the week. In the past, there have been these town hall meetings where there's been a lot of commotion and outrage. As we look toward this one, and on the heels of that, 2 legislative days to hammer out some sort of deal here on whether or not to avert a government shutdown, what does that recess look like for members of the House and the Senate?
It looks bad. I mean, they are getting increased funding for military police protection. They're going to need all of that. I suspect most of the events would be inside if they're held at all. I imagine we hear a lot more about like virtual town halls. We had already seen so much Democratic outcry from Democratic constituents at Republican town halls across the country that a lot of members had been putting up placards about the rules of civility and canceling events outright. I think you've seen a lot of cancellations and a lot of concern about political violence. And there's an undercurrent feeling that, this is going to lead somewhere else. There will be another political violence act. So I know that's top of mind for a lot of members.
Henrietta, last question. In your most recent note, you put 25% odds on a shutdown here. What gives you the confidence here to keep it? What is relatively low, I think, by a lot of standards. There have been many people who think that Democrats are going to allow one to happen this time around. Why do you feel like it's unlikely?
Sure. And I'm usually on the low end, and I don't put a lot of stock in the narrative that there's going to be a shutdown, especially when we're 15 days out from the 30th. That's like a lifetime in D.C. Language. I get my information from staff, which I think differentiates me from some other folks. I don't really talk to members all that often. I really very much care what staff has to say because they're the ones with the finger on the pulse. And the read that I get is that House members are much more inclined to encourage a shutdown. The senators just aren't there. And until that changes, I'm going to keep my low odds at 25%. We're probably going to take this into September 29th and 30th. Things will look funky. Wow. This week is going to be a lot of drama. But with a 10-day recess, a lot can change.
Henrietta, thank you so much. Look forward to speaking to you again soon. Henrietta Treyz with Veda Partners. Just terrific perspective on Washington. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Get lucky with the timing. Anastasia Amoroso with us this morning, and that is a wonderful thing. She is at Partners, and of course has been just incredibly prescient about the need to be in the market. I have to read this tweet in full from the President of the United States. Anastasia, listen carefully. It's detailed. Subject to SEC approval, companies and corporations should no longer be forced to, quote, report, unquote, on a quarterly basis, but rather to report a 6-month basis. I would note, folks, very much like most European companies. This will save money and allow managers to focus on properly running their companies. Did you ever hear the statement that, quote, China has a 50 to 100-year view on management of a company, whereas we run our companies on a quarterly basis, question marks, not good, 3 exclamation points. You and I know this has been a raging debate since you were an undergrad at New Mexico a million years ago. Should we go like Europe to twice-a-year reporting?
A million years indeed. Look, I think there are some sympathizers with that in public markets, that maybe quarterly reporting can be made more efficient by stretching that out. And I sort of think about JP Morgan and Jamie Dimon periodically talking about that as well. So look, we now focus our time on private markets, Tom, and we're certainly sympathetic to making changes over a course of many, many years. That I think there are great benefits to that, for sure.
The history of this, folks, is in the old days, you had a value line on your floor that was 8 inches thick, and you trip over it about once every 10 days. And you had the back of the Wall Street Journal, which showed revenues, net income, and shares. That was the earnings season. Now, Anastasia, it's a parlor game. It's a frenzy. I'm as guilty of it as anybody else. Should we get away from that frenzy?
Well, I don't think we should completely get away from that. I do think it's important to keep investors abreast of what's happening. And, it has become, I guess, a bit of a game, though, because you set the expectations, you reset them lower, you beat the lower bar. But I do think, part of the reason why there's still the existence of public versus private markets is some investors like that transparency. And I think the lines would get too blurred if we were to go to any less cadence. Now, I will say in private markets, if we don't have the scrutiny of the quarterly reporting, there's so much more that we can do in terms of transforming supply chains, building out margins over a course of time. So I think that's where that belongs.
David, the catch that drives people nuts is you're on a conference call with 85 analysts, and they go, and now the guy from da-da-da-da-da, and you go, great quarter, drives me insane. Continue. Maybe we should talk about the markets right now, Mr. Gura.
Well, let's dovetail your work in the private markets with the public ones. And I'm curious sort of how you look at the enthusiasm that we've noted over the last few days in initial public offerings, companies wanting to merge with one another. I think there have been a number of days over the last week or so when we've headlined a big deal merger that's happened here. How do you see that atmosphere, that environment right now?
Right. Well, it is kind of a tidal change, to be honest, in terms of the activity that we've seen in M&A and IPO markets. And I'll focus on IPOs in particular because that's where we've seen sort of the most notable pickup. Global IPO volumes are up about 25% year over year. But we've had in America, especially, we've had an incredibly robust August, an incredibly robust September, and it's sort of been a long time coming. Now, I guess the question is, does it continue? And our answer is yes, it most likely does, because you've got a comeback of CEO confidence. You got now the rate cut, of course, that we're anticipating, and a few more this year, which should support valuations. And then if you look at the performance of the IPOs this year, the S&P is up about 11, 12%, depending on the day. The average performance of an IPO stock today, this year, I should say, is about 38%. So all of that should continue to be the incentive. I will say, David, this has obviously been supportive for the public markets. It's been supportive for private market managers. It's certainly been supportive for our platform as well. And we're seeing of the top 25 IPOs, we've participated in close to half of those. So clearly a significant value unlock for the industry.
You mentioned that uncertainty abating. I wonder sort of what is still stuff that needs to be figured out as you see it. So we've got the Treasury Secretary and the U.S. Trade Representative in Spain right now still haggling with China, trying to find some resolution to what seems like a very difficult situation to brook. Where is the uncertainty? What needs to be resolved for this to kind of come into its own more fully?
Right. I think when you think about it tactically, some of the trade negotiations, and also do we actually have the legal authority to impose tariffs in the fashion that they were imposed? Obviously some court decisions are still pending there. That's kind of the tactical side of it. But I think to me, the bigger uncertainty that needs to be settled and resolved is look at the labor market. It is weakening, and we see more and more signs of that. So obviously the markets are exuberant about the rate cuts and supporting the economy. But what if we don't get enough Fed action quickly enough? What if the labor market does actually sort of turn before the Fed can support it? That's sort of the biggest uncertainty in my mind. As I look into 2026, yes, the outlook is supportive because we got the tax cuts that are coming in. But the biggest concern for me, will the Fed act quickly enough to cushion the labor market now?
But you say the market. This came up like 8 times this weekend. It's not the market anymore. And you nailed this 6 months, 8 months, a year ago. We have this one parcel of the market, Mag 7, whatever, tech, it's doing exceptionally well, and everything else is really mediocre. How do you play it at Partners? Are you still Mag 7 tech focused, large cap focused?
Right. Well, at Partners Group, we look at large mega trends, and we also look at some of the 4 sectors along which we invest. And it's looking, of course, to technology. We certainly are investing in artificial intelligence, not only investing in it, but also thinking about who might be disrupted by it. We look at things like goods and products. So think consumer products, think industrial products, services. Let's say we like utilities, but we also like servicing utilities companies. And of course, life sciences and pharmaceutical services is the other pillar that we look at. So that's how we look at it in private markets. In public markets, I would say, Tom, the conversation continues. Is the AI momentum still there? For us, the answer at Partners Group, it still very much is. And just look at what happened with Oracle, for example, last week. And the fact that they went from guiding...
Never seen it.
Well,
Never.
Not since 1992, right? And, the fact that they went from revising their cloud infrastructure revenue from $18 billion to $144 billion over the next 5 years, that's monumental. And that really tells you that the AI momentum is continuing. So at Partners Group, we think about investing it obviously in application software, but also in infrastructure. And there's probably 3, 4, 5 ways in which you can invest in AI and infrastructure.
Give us a window into that for private market stuff I wouldn't understand. How do you do AI, data, electricity generation, infrastructure away from the Dow Jones Industrial Average?
Right. Let's talk about infrastructure, and let's talk about the 3 or 4 or 5 ways. I mean, the first one, of course, how about, data centers, which I realize, Tom, it's a theme that's well talked about. And at the same time, if you look at the growth in data centers, it's still forecasted to be 14% per annum for the next number of years. So data centers, and I will say building a traditional data center versus building an AI data center are 2 very different things. And what you need for an AI data center, first of all, you need a lot more power, capacity, power density. So that's a different requirement. If you're going to run those racks of GPUs that require a whole lot more power, that's a whole different cooling requirement. So we have to think about that. And then also, Tom, especially if you're not doing training, if you're doing AI inference, latency and that, speed of transferring data is really paramount. So building out the fiber capabilities, 5G capabilities is all that we think about in terms of the data center design. So quite different than just the traditional stuff, and certainly quite different than just semiconductors.
How about electricity generation? And we're talking about bills are going up. The demand for electricity is going up. Fight over who gets the electricity is certainly becoming a roiling debate as well. How do you see all of that playing out? Are you someone who sees nuclear as the solution here? How is that going to sort of shape the way this arc with AI continues to grow?
Yeah. Well, first of all, some kind of big picture stats. If you look at the electricity generation for the last 25 years, it has not grown. But if you look at the electricity generation forecast for the next 25 years, it is forecast to grow at 38%. That's in terms of demand for electricity. Some of it comes from AI, some of it comes from just the electrification of transportation. But here's the stat. Something like 700 terawatt hours is what's required in terms of additional capacity that we have to build out. So that's why I think in public markets, utilities, for example, have done fairly well this year. And that is a trend that we certainly see continuing because they'll be at the forefront of bridging that gap.
Pull things back here to the Fed meeting this week. Want to get a sense of what you're expecting out of that, but also what that decision, and I suppose subsequent decisions, the way that they unfold, how they're sequenced, is likely to mean for investors.
Right. I mean, 25 basis points is obviously the base.
Fed has decided, Tom, to steal the name of your show and rework it.
It is about to decide, but I do really hope that not only do they decide on the 25 basis points now, but also another in the end of October and another one in December. And, again, I say that is because the labor market is sort of on the verge of slipping into further weakness. And if they worry about inflation, that's sort of a backwards looking worry, because if all of a sudden you don't have the labor market, you don't have the consumer spending 4 or 5% year over year as we are doing today, then that inflationary concern can very quickly pivot into a deflationary concern. So I do hope that not only do we get the rate cut this week, but we get a pretty strong indication that this is a beginning of a rate cutting cycle.
That forecast will matter.
That's right. I think that's really key to the markets, because think about it, 25 basis points, that doesn't really cushion the economy. 75 basis points, that could translate to economic benefit. And, one example I would give you is obviously tariffs are a cost for corporations. They're absorbing them in their margins, but what are they doing instead? They're maybe laying off workers, maybe they're not hiring workers. But if you can free up 75 basis points of interest expense, that can be used for other purposes. And that's the support for the economy.
I look at this, Anastasia, and I think of other guests we've had who've just said, look, invest in America. And you've been one of the most strident voices that say you have to participate in American capitalism.
Yeah.
Talk to people that are still scared stiff. They see the political trauma of this nation that we talked about earlier with Henrietta. State again the case to invest in America.
Right. Well, let's talk about the facts. And I was never in the camp of the American exceptionalism is over. And the reason for that, let's just talk about the backdrop for corporate America. And one of the things that the tax bill did is solidify the fact that the corporate tax rate in the United States is going to be 21%. After accounting for certain deductions, it's probably closer to about 19%. The big deal about that, Tom, is if you look at some of the other developed market economies, the average is 25% or higher in some instances. So all of a sudden, you have an incredibly friendly corporate tax regime that on top of that, there's a couple of things in the tax bill that are even more friendly. And I'm talking about the 100% bonus depreciation. So if you invest today in America, you get that 100% bonus depreciation in year one. That has been made permanent. So that is a long-term boost to U.S. GDP. If you invest in R&D in the United States, that's again a 100% deduction in year one versus the 5-year stretch out before. So you package that together, that's an incredible incentive to invest in America.
Anastasia, thanks so much. Anastasia Amoroso nailed the bull market. She is with Partners Group. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
David Gurney. David Gurney. David Gura.
Time to go.
3,
it's
2,
been
1.
fun.
David Gura. I need more Senka. David Gura in for Paul Sweeney right now. She'll save me. Let's get to the newspapers. El Mateo.
I don't know if I'll save you, but I'll try. Here we go. Okay. So we've been talking about how AI is transforming corporate America, right? But this is something interesting from Goldman Sachs. They say its growth is understated in government data. So they say AI added $160 billion to the U.S. economy, but only $45 billion shows up in GDP. And analysts are saying that leaves about $115 billion unaccounted for. The reason how this is happening is they say because semiconductors treated as intermediate inputs, which are only counted toward that final demand when products like things like consumer laptops that they enable are sold. So the chips in recent years, they're being developed for things like training, supporting AI models. So these Goldman analysts are estimating that about $75 billion spent on developing AI models and solutions in the cloud, they have not been counted in these investment statistics. So it's an interesting number to think about when all the talk we've been having about AI and its influence on corporate America.
Fascinating to think about. I mean, we had that conversation last week just about productivity and how that's still something that's so amorphous with the effect that AI is going to have on productivity.
Hugely amorphous. We're not going to go into it now because it's 3 ratios. Last week, that conversation with Heath Terry of Citibank was extraordinary. And Lisa, he said, expert, it's moving so damn fast.
Yeah.
Was what Mr. Terry said. Next, what do you
Most definitely. Okay, I want to take it to the entertainment media space. We know about David Ellison, right, acquiring Paramount. Now he's hiring financial advisors to get ready to buy Warner Brothers Discovery. But this is an interesting read in Bloomberg Screen Time newsletter as to why now. So they're saying, you know what, he could have waited to do this whole Paramount Skydance and see where things stop. Warner Brothers could have even been cheaper if he waited. But if he did, he'd risk into running into a different regulatory regime.
A different president.
That's the thing.
This is all about the president.
Correct. And if he waited, he could have also have other parties could have made a play for Warner Brothers. He could have had that. But now, Bloomberg Screen Time is saying the likely list of buyers is short. So, I mean, now is, possibly the right time to do this.
I read every word of Screen Time. Can't say enough about it. His event in October is it's got goosebumps. It's got everybody. Yeah,
we can't get tickets. We can't get in, you and I. That's how oversubscribed it is. You got to be cool, to get in. But the basic idea here is, what do you do with old media that permeates every paragraph of a newsletter?
Right.
What does Warner Brothers? What does Paramount do with, I guess, the movies? And I guess they're not worth all that much.
Right.
I mean, it's
great. It makes you think. It really does.
It makes you think about where are we in 5 years.
Yeah.
How much TV was watched at the Gura House?
Well, quite a bit yesterday. I don't know what game we didn't watch, but Brian Weezer was so good on this last week.
We didn't have enough. We got
enough time with him, but he was
sorry,
very Madison while trying to.
Can you? I know it's 3 layers below you, but can you tell the team? If you have time to go that low on a tree, that we'd like to get Brian Weezer back again, because he was shorted last week with all the emergency stuff we did. Do you have anything else for us?
I do. And this one might touch your heartstrings a little bit.
All
okay,
right.
So moms and dads, right? For years they've been taken after the kids, and now they send them off to college. And now it's setting in, right? What do I do?
He's getting emotional, Lisa.
And what do I do with this new chapter in my life? You know, it does get emotional. I got a year to go, and then I'm going to be in the same spot. And how you're feeling. Some are finding it liberating, but others are having a really tough time with it because they're so used to.
Tom's got his hard hat on. He's finding it pretty liberating as he renovates the apartment.
The hardest part is the messaging, the iPhone. Like the messaging. I did this exactly 50 years ago. 4 a.m. Did I wake you?
Yeah, well.
But I bet you treasured that text message. You know, like it
oh, shut up.
I'm going to get it out of him.
You're killing me. Let's go
Our
to David
listeners on the radio
right
tears from Tom Keene.
The newspapers with Lisa Mateo this morning.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.